ખબરોમાં બન્યા રહેવા માટે બેલ આઇકોન દબાવો અને ABP અસ્મિતાને સબસ્ક્રાઇબ કરો.
Cautionary steps which we are required to take, all of us, I decided to address the media. And since there is no press conference, I have tried to make my statement as explanatory as possible, as self-explanatory as possible, so that the room for questions, etc., are minimized considerably. So therefore, the statement is a bit long. I request your patience. And I would also request you to please be patient till the end, because towards the concluding paragraphs, I have tried to give some forward guidance. In view of the COVID-19 pandemic, the Monetary Policy Committee decided to advance its meeting, which was originally scheduled on 31st March and 3rd April, and the announcement was due to be made on 3rd April. We decided to announce it to 24th, 26th and 27th. Accordingly, the MPC met on 24th, 26th and 27th March and undertook a careful evaluation of the current and evolving macroeconomic and financial conditions, and of course the outlook. I wish to take this opportunity to express my sincere thanks to the MPC members for responding so quickly. I also wish to place on record my appreciation of all the staff and officers of RBI for their excellent cooperation in facilitating this. After extensive discussions, the MPC voted for a sizable reduction in the policy repo rate and for maintaining the accommodative stance of monetary policy as long as necessary to revive growth, mitigate the impact of COVID-19, while ensuring that inflation remains within the target. While there were some differences in the quantum of reduction, the MPC voted by a 4-2 majority, that is, by a 4:2 majority, to reduce the policy repo rate by 75 basis points to 4.4%. I repeat, the rate cut decision is 75 basis points, and accordingly the repo rate stands reduced from 5.15% to 4.4%. Simultaneously, the fixed rate reverse repo rate, which sets the floor of the liquidity adjustment facility, that is the LAF corridor, was reduced by 90 basis points. I repeat, 90 basis points to 4%, thus creating an asymmetrical corridor. The purpose of this measure relating to reverse repo is to make it relatively unattractive for banks to passively deposit funds with the Reserve Bank, and instead to use these funds for on-lending to the productive sectors of the economy. It may be recalled that during the month of March so far, the banks have been parking close to rupees 3 lakh crore on a daily average basis under the reverse repo, even as the growth of bank credit has been steadily slowing down. This decision and the advancement of the MPC has been warranted by the disruptive force of the coronavirus. It is intended to 1. Mitigate the negative effects of the virus, 2. To revive growth, and above all, number 3, to preserve financial stability. We are living through an extraordinary and unprecedented situation. Everything hinges on the depth of the COVID-19 outbreak, its spread and its duration. Clearly, a war effort has to be mounted and is being mounted to combat the virus, involving both conventional and unconventional measures in a continuously battle-ready mode. Life in the time of COVID-19 has been one of unprecedented loss and isolation. Yet, it is worthwhile to remember that tough times never last. Only tough people and tough institutions do. In the recent period, Reserve Bank has been in action on a daily basis with efforts to alleviate financial stress, build confidence, and keep the financial system sound and functioning. And we have taken a number of steps over the last 1 month or so since the conclusion of the last MPC meeting. In my statement, I have listed out the measures which have been taken. For the sake of time, I am not reading it out. Once the statement is uploaded, I think those who are interested can have a look at it. Let me assure that the Reserve Bank is at work and in mission mode, monitoring the evolving financial market and macroeconomic conditions, and calibrating its operations to meet any need for additional liquidity support, as well as to undertake other measures as may be warranted. It is our effort to ensure normal functioning of the markets, nurture the impulses of growth, and preserve, I repeat, and preserve financial stability. Incidentally, we have in RBI quarantined 150 members of our staff and service providers, together with the IT facilitators and the entire IT facility, as a part of our business continuity plan. The plan was prepared and executed in a matter of days. The MPC noted that global economic activity has come to a near standstill as COVID-19 related lockdowns and social distancing are imposed across a widening swath of affected countries. Expectations of a shallow recovery in 2020 from 2019's decade low in global growth have been dashed. The outlook is now heavily contingent upon the intensity, spread, and duration of the pandemic. There is a rising probability that large parts of the global economy will slip into recession. Turning to growth in India, the implied GDP growth of 4.7% in Q4 of 1920 in the second advance estimates of the National Statistics Office, which was released in February 2020, within the annual estimate of 5% for the year as a whole, is now at risk. As regards the outlook for 2021, apart from continuing resilience of agriculture and allied activities, most other sectors of the economy will be adversely impacted by the pandemic, depending upon, I repeat, its intensity, spread, and duration. We have to recognize that the government has taken timely and appropriate measures to contain these three factors, that is, to contain intensity, spread, and duration. And let us all cooperate with the measures announced by the government to deal with the problem, to prevent the spread of coronavirus, to contain it and win this war. If COVID-19 is prolonged and supply chain disruptions get accentuated, now these are risk factors which I am listing out. It all depends how we respond to the situation. I am just listing out the risk factors. Only time will tell how effectively we have acted as a nation and how effectively we have been able to contain the spread of coronavirus and how effectively we have been able to restrict its adverse impact on our growth. So if COVID-19 is prolonged and the supply chain disruptions get accentuated, the global slowdown could deepen with adverse implications for India. The slump in international crude prices could, however, provide some relief in the form of terms of trade gains. Downside risks to growth arise from the spread of COVID-19 and prolonged lockdowns. Upside growth impulses are expected to emanate from monetary, fiscal, and other policy measures and the early containment of COVID-19. As regards inflation, the prints of January and February 2020 indicate that actual outcomes for the quarter are running 30 basis points above our earlier projections, reflecting the onion price shock. Looking ahead, food prices may soften even further under the beneficial effects of the record food grain and horticulture production, at least till the onset of the usual summer uptake. Furthermore, the collapse in the crude prices could work towards easing both fuel and core inflation pressures, depending on the level of pass-through to the retail prices. As a consequence of COVID-19, aggregate demand may weaken and ease core inflation further. Heightened volatility in financial markets could also have a bearing on inflation. Given this heightened volatility, unprecedented uncertainty, an extremely fluid state of affairs, projections of growth and inflation would be heavily contingent on, as I earlier said, the intensity, spread and duration of COVID-19. Precisely for these reasons, the MPC decided to refrain from giving out specific growth and inflation numbers because the situation is fast changing and the outlook is extremely uncertain. In fact, this kind of uncertain outlook has never been seen before. And as I mentioned earlier, I would again like to repeat that if we, all of us, every citizen, every person who lives in this country, if we follow the rules, if we follow the advices given by the government and other authorities, then as a country we should be able to win this war against COVID-19, in which case much of the worries that we have in our growth outlook would get considerably reduced. The MPC noted that macroeconomic risks both on the demand and supply side brought on by the pandemic could be severe. The need of the hour is to do whatever is necessary to shield the domestic economy from the pandemic. The Government of India has yesterday announced a number of measures which are expected to provide relief to various disadvantaged sections of the society. The MPC further noted that the Reserve Bank has taken several measures to inject substantial liquidity in the system. Nonetheless, the priority is to undertake strong and purposeful action in order to minimize the adverse macroeconomic impact of the pandemic. It also underscored the need for all stakeholders to fight against the pandemic. Banks and other financial institutions should do all that they can to keep the credit flowing to the economic agents which are facing financial stress on account of the isolation that the virus has imposed. Market participants should work with regulators like the Reserve Bank and the SEBI to ensure the orderly functioning of markets in their role of price discovery and financial intermediation. Strong fiscal measures are of course critical to deal with the situation. To summarize, COVID-19 stalks the global economy and the outlook is highly uncertain and of course negative. Several nations are battling its exponential contagion. Countries are shutting down to prevent being sucked into a kind of black hole. Authorities all over the world are mobilizing on a massive scale to fight an invisible assassin. India has locked down economic activity and financial markets are under severe stress. Finance is the lifeline of the economy. Keeping it flowing is the paramount objective of the Reserve Bank of India at this point of time. The time has therefore now come for the Reserve Bank to unleash an array of instruments from its arsenal to staunch and mitigate the impact of COVID-19, revive growth and above all, preserve financial stability. The aggregate action and stance of MPC provides a befitting launching pad. In turn, the configuration of initiatives unveiled in the Statement on Development and Regulatory Policies, which I am now going to spell out, amplify the MPC's decision and leverages on it as well. Accordingly, it is appropriate that the MPC's decision and the other actions which I am now going to elaborate upon should be regarded as a comprehensive package with force multipliers. The developmental and regulatory policies can broadly be delineated under 4 categories. First, measures to expand liquidity in the system sizably to ensure that financial markets and institutions are able to function normally in the face of COVID-related dislocations. 2, steps to reinforce monetary transmission so that bank credit flows on easier terms are sustained to all those who have been affected by the pandemic. 3, efforts to ease financial stress caused by COVID-19 disruptions by relaxing repayment pressures and improving access to working capital. And 4, endeavor to improve the functioning of markets in view of the high volatility experienced with the onset and spread of the pandemic. I would announce them in broadly 3 sections. The first section relates to liquidity measures. A multi-pronged approach comprising both targeted and system-wide liquidity provision has been adopted to ensure that COVID-related liquidity constraints are eased. The first announcement relates to targeted long-term repo operations, TLTRO. Let me elaborate further. Large sell-offs in the domestic equity, bond and forex markets have intensified redemption pressures. Liquidity premia on instruments such as corporate bonds, commercial papers and non-convertible and debentures have surged. Financial conditions for these instruments, which are used inter alia to access working capital in the face of the slowdown in bank credit, have also tightened. To mitigate the adverse effects on the economic activity leading to pressures on cash flows across sectors, the Reserve Bank will conduct auctions of targeted long-term repos of up to 3-year tenor of appropriate sizes for a total amount up to rupees 1 lakh crore at a floating rate linked to policy repo rate. Liquidity availed under the scheme by the banks has to be deployed in investment-grade corporate bonds, commercial paper and non-convertible debentures over and above the outstanding level of their investments in these bonds as on March 25, 2020. Eligible instruments comprise both primary market issuance as well as secondary market purchases, including from